Chapter 4 in my book is a case study for a friend that asked me to review her wealth portfolio on June 30th, 2016. Eleanor recently sold her business and is working part-time at a new company with a tax-deferred plan. Her current marginal tax bracket is 20%. She is a single mom, age 57, with 2 children and 529 plans. Eleanor is a homeowner and plans to retire in 5 to 8 years. She has 2 advisor accounts, each with a 1.15% assets under management fee, a traditional IRA with $677,000, and an investment account with $205,000. After reviewing Eleanor's statements, I made the following notes. $10,150 per year in advisor fees. That is an opportunity cost to save and invest. The number of funds in her IRA is 35, and 16 funds in her brokerage account. That is unnecessary complexity. There is no indication of fund expense ratios on statements implies a lack of transparency. Is 75% stocks in the managed accounts appropriate? High-yield bonds and accounts overstate expected yields. Furthermore, their high correlation with stocks imply little diversification benefit. Why are municipal bonds in the portfolio? Eleanor's marginal tax rate is 20%, not 39.6%, and she is actually losing money on the municipal bond funds. The SEC yield on the fund is 1.17%, which is less than the 1.59% from advisor fees and the fund expense ratio. Furthermore, Eleanor is losing money on cash in all funds. The current 3-month T-bill rate is 0.26%, which is considerably less than the 1.15% advisory fee plus an expense ratio. Why pay an advisor to manage your cash? The investments among accounts are not tax efficient. There is significant managerial risk in active fund investment managers and the advisor. Furthermore, the company tax-deferred account is 100% invested in a balanced fund. That is not balanced. It is 85% in stocks, and the average bond quality is below investment grade at BB. And it has a 1.14% fund expense ratio plus an administrative 0.72% net asset fee. In order to evaluate a portfolio, we need some investment discipline. This is attainable with a benchmark strategy that must be established to measure suitability and performance. Step 1 is to define a low-cost, well-diversified, investable set of market proxies for cash, bond, and stock benchmark portfolios. Step 2 is to define a strategic asset allocation by selecting the percentage invested in the cash, bond, and stock market benchmark portfolios consistent with investor objectives, including risk tolerance. Step 1 involves selecting mutual funds, or ETFs, that is most representative of the 3 sectors. Note the representative sector fund choices and allocations. This default set of proxies is for a US-centric investor. A global-centric choice is also available. However, the user can customize by expanding the bond and stock sectors with more fund choices and allocation percentages. Step 2 involves a strategic asset allocation by selecting the percentages to be invested in the cash, bond, and stock proxy sectors consistent with investor preferences and risk tolerance. After significant deliberation, Eleanor chose 45% in stocks, 4% cash, and 51% in bonds. We can now analyze Eleanor's June 30th, 2016 balance sheet and wealth portfolio dashboard in Ripsaw Wealth Tools. Note the interesting highlights. The current market value net worth in the dashboard does not match the balance sheet net worth. In a wealth level context with real estate, the stock percentage of 30% does not appear that large. Why is the bond allocation negative? Yield so low and expenses so high? The discrepancy in net worth numbers is because the balance sheet treats the home mortgage loan as outstanding balance or book value, while the Ripsaw dashboard calculates market value that includes the value to the homeowner at the current mortgage refinance rate. If current rates are lower than what Eleanor is paying on a high-rate mortgage, she is losing the present value of those savings. Now we can see the stock percentage appears low due to a relatively large home value and a large, probably inefficient cash position. In a wealth portfolio context, a mortgage is a bond. The negative bond percentage is because the borrowing or short position of the mortgage is greater than all the long bond allocations in Eleanor's investment portfolio. In a wealth portfolio context, the yield is very low relative to the benchmark because of the mortgage payment outflow and the inefficient use of cash at very low interest rates. Separately, expenses are extremely high relative to the benchmark. A touch of the home auto icon takes out real assets and associated loans to focus on the investment portfolio. Now we can see the positive, although underweight, investment in the bond sector, and a better, although still considerably less than benchmark, asset yield. Now we can proceed with mortgage, company IRA, and managed investment decisions. Eleanor's original $554,000 mortgage is a 15-year, 5.375% fixed rate that has a remaining balance of $349,708 after 7 years. The current market rate on a mortgage for the remaining 8 years is 3.5%. Eleanor is losing a present value of $25,764 by not refinancing the loan and paying the lower rate for the remaining 8 years. Since she could easily qualify with a 33% loan-to-value ratio on her home, refinancing seems like a no-brainer decision. However, Eleanor has already accumulated significant wealth and is getting closer to retirement with a shorter investment horizon and less risk tolerance. Hence, considering paying off the mortgage completely rather than refinancing is also an option to save on the rate. In Ripsaw's revision mode, paying down the mortgage from her savings account increases Eleanor's wealth portfolio market value by the same $25,764 as in a refinancing, but also increases yield close to the benchmark and improves the bond allocation percentage. Now that we have taken away a lot of the investment portfolio cash overweight, the stock allocation overweight is revealed, and the bond allocation is still underweight. Now we can focus on investment mode. Note the drop in revised aggregate value to $1,010,000, resulting from using the savings account to pay down the home mortgage. The current company IRA is invested 100% in a balance fund with a 1.14% expense ratio, but is not really a balanced strategy. The lowest expense ratio available on the list of fund choices in the company plan is 0.57% for an S&P 500 index fund with little managerial risk. Therefore, we use Ripsaw's revision mode to sell the balance fund and buy the index fund. The issue to focus on next is which stocks to sell and use the proceeds and excess cash to buy which bonds. Looking at Eleanor's managed IRA, there are fund expense ratios well over 1%, high account management fees, and excess cash allocations in the funds. And much the same problems exist in Eleanor's managed brokerage account. The portfolio revision can be achieved in a three-step process. Step 1 is to eliminate the high advisor fees and improve investment choices. One can transfer all of these securities to new self-directed IRA and brokerage accounts and make revisions there. Given that there are no significant capital gains subject to tax, Eleanor can also liquidate the current IRA and brokerage accounts and move all the cash to the new Vanguard Rollover IRA and brokerage accounts respectively. Step 2 is that Eleanor's benchmark cash allocation is near $40,000, and she only requires $20,000 in ready cash. Hence, she can move $103,000 from her savings account to her new Vanguard brokerage account for more investment choices. Step 3 will be to determine the portfolio revisions. Completing the mortgage paydown, company IRA revision, and the transfers from the liquidated managed accounts to new Vanguard accounts result in an investment portfolio that is almost all in cash with no management fees, no bonds, no mortgage, and only the small investment in the S&P 500 index within the company tax-deferred plan. Now the portfolio selection process will proceed more quickly by predetermining some criteria to build Eleanor's efficient portfolio. Number 1 is to use low-cost index funds for specific factor exposures without managerial risk. Hence, there will be a preference for index funds, especially ETFs. Number 2 is to allocate more of the higher dividend yield stocks and bonds to tax-deferred accounts. Number 3 is to have low interest rate risk in this extremely low rate environment with short to intermediate term bonds. Number 4 is that given the insufficient below investment grade default risk premium, select up in quality corporate bonds. Number 5 is to add mortgage-backed securities for diversification and compensation. Employing Ripsaw's Enhanced Fund Screener, we found 6 transparent funds that provide precise risk exposures, diversification, and tax efficiency with the potential to closely match Eleanor's customized benchmark. Note that we are unbundling the large cap sector into the equally dollar-weighted combination of the large cap growth ETF and the large cap value ETF. Together, they closely match the total large cap index, but can be more tax efficiently allocated by having the lower dividend yield growth fund in the brokerage account and the higher dividend yield value fund in the tax-deferred IRA account. This is unbundling for tax efficiency. The low dividend small cap ETF is also used in the brokerage account, while most of the bond fund dollar allocations are in the tax-deferred IRA account. Also note that all funds employed have relatively low expense ratios with clear risk exposures, and as index funds, little to no managerial risk. Since we want more in bonds and stocks and tax efficiency, let's start with a 60% bond and 40% stock allocation in the IRA account with equal weights within the sectors. That is 20% in each of the 2 stock funds and 30% in each of the two bond funds. In the brokerage account, we want to closely match the dollar amount in the growth fund as we have in the value fund in the IRA account. This is for tax efficiency, so no tilt is intended. 45% in VUG in the taxable brokerage account is close enough for this first pass. 20% in VB is intended to get the necessary small cap exposure, and the remaining 35% in the short-term investment grade bond fund is for liquidity. The cash, bond, and stock allocations for the first pass revised portfolio is not that far off from the benchmark weights. The composition of the stock portfolio, however, is clearly underweight U.S. stocks and overweight international stocks. It is also underweighting large cap stocks and overweight mid cap stocks. The initial bond allocation appears to have succeeded in reducing the bond default risk considerably compared to the managed accounts. The lower allocation to the BBB bonds within the investment grade sector is even higher quality than the benchmark. The stock portfolio overweight in international can be reduced by selling 6% of the total international fund and buying 2.5% more in the value ETF. The remaining 3.5% can be allocated equally to the bond funds, 1.75% to the short-term investment grade fund, and 1.75% to the Ginnie Mae fund. In order to match the dollar allocation of the large cap value fund in the IRA account, we raised the allocation to the large cap growth fund 4.5% to 49.5% in Eleanor's brokerage account. That is achieved by reducing the short-term investment grade fund by 2.5% and the previously slightly overweight small cap stock allocation by 2%. The investment portfolio dashboard now indicates that the stock portfolio composition is close to the benchmark. Note that because of the overlap of mid-cap stocks in the small cap and large cap funds, there was no need to include a separate mid-cap fund. And we maintain the intended short-term up-in-quality bond strategy. This is a temporary tactical deviation from the benchmark to maintain lower default and interest rate risks than the benchmark. We can now review Eleanor's wealth portfolio dashboard to see if her objectives have been obtained. Eleanor's wealth portfolio meets her investment objectives for risk tolerance and cash flow. There is significantly less bond default risk and interest rate risk in her portfolio. She eliminated the municipal bond and excess cash fund money losers. The stock and bond subportfolios obtained preferred risk exposure and diversification objectives. Eleanor's yield is up $24,060, and expenses are down $13,639 for a net gain of $37,699. Improved after-tax returns with IRA versus brokerage allocations. Eliminated advisor and fund managerial risks and replaced them with full transparency. Monitoring and revision are ongoing, especially as retirement approaches. The frequency of portfolio monitoring and revision depends on the complexity of your portfolio and its sensitivity to market events. Although a regular monthly review is good practice, a life change, a major cash investment inflow or outflow, or the emergence of significant market volatility should instigate an immediate review. Here is a minimal checklist for portfolio monitoring and revision decisions. Now let's explore how to implement a portfolio tilt for expected return enhancement. Like the importance of the overall cash, bond, and stock asset allocation decision, the asset allocation within the stock and bond subportfolios have similar risk-reward implications. The implementation requires a two-step process. First, we replicate the benchmark portfolio with its components. Then we implement the tilt by altering the component investment weights. In this slide, we are replicating the investment grade bond market benchmark BND. There are three major risks in this bond benchmark: default risk in corporate bonds represented by VTC, and prepayment risk in MBS by VMBS. Both of these sectors have interest rate risk, but the net portfolio interest rate risk exposure can be managed with the Treasury sector combination of short, intermediate, and long-term Treasury funds. The replication weights selected indicate a close default and interest rate risk match to the benchmark. The slight overweight in MBS was employed to also represent its small securitized relatives in the ABS and CMBS sectors in the benchmark. The overweight in corporate bonds is to get the BBB credit sector up to the benchmark level from the small underweight in the government-related sector. Now we can do what the professionals do to beat the benchmark without any special information or insight. Reduce the Treasury weight by 20% and add 10% to each of the corporate bond and mortgage sectors. For professionals or individuals with long-term objectives, on average, they will earn the risk premium. However, short-term tracking error can be high. The exact percentage spread product overweight is a function of investor risk tolerance. In the sector risk distribution, we observed the intended overweights in MBS and corporate bonds and the underweight in government bonds. This is consistent with the observed underweight in AAA and overweights in the A and BBB bond subsectors. There is still the decision of what interest rate risk level to achieve. A 30-year mortgage with amortizing principal payments and prepayments actually has interest rate risk that is closer to an intermediate term Treasury at origination and more like a short-term Treasury if rates decline substantially and prepayments speed up. Corporate bonds also have less interest rate risk than comparable maturity Treasuries because the sensitivity of corporate bond prices to changes in the level of Treasury rates are mitigated by changes in default expectations. Therefore, the appearance of underweighting the 3 to 5 and 5 to 7 year maturity sectors by selling the short-term and intermediate-term Treasury funds to overweight the MBS and corporate bond sectors will actually maintain a similar level of interest rate risk as the benchmark. If our objective, however, was to lower interest rate risk, we could fund more of the MBS and corporate bond purchases by selling the long-term Treasury fund. Increasing net interest rate risk could be accomplished by funding more of the MBS and corporate bond purchases by selling more of the short-term Treasury fund. One could also unbundle the corporate bond sector into short-term, intermediate-term, and long-term corporate bond funds for more control over both interest rate risk and default risk by maturity. Tactical asset allocation tilts to stock factors are common strategies. Consider a disciplined approach to a small cap overweight, a capitalization replication for the total U.S. stock market benchmark VTI, with the selected weights of 80% in the iShares Core S&P 500, 12% in Vanguard Mid Cap ETF, and 8% in the Fidelity Small Cap Fund, replicates the capitalization, value blend growth, and sector distributions of the benchmark well. Note that we selected the Fidelity Small Cap Fund because its composition was over 77% in small cap stocks. That is, it represents more of the small cap exposure we are interested in. Other funds with small cap in its name have considerably less exposure to the subsector we are interested in. Here is an example of a 12% overweight in small cap from a 10% reduction in large cap and a 2% reduction in mid cap funds. Note that we get the desired small cap overweight and large cap underweight without affecting the value of blend growth and sector distributions relative to the benchmark. We isolated the trade. Thank you for taking the time to listen to my views on wealth management. Today we have covered the motivation and provided some examples of disciplined wealth portfolio management in the current economic environment. There are many more concepts covered in my ebook and paperback versions of Do-It-Yourself Wealth Management. Furthermore, portfolio construction, monitoring, and revising portfolios can be efficiently accomplished with Ripsaw Wealth tools. Each individual and family is unique and will not optimally fit into a cookie-cutter strategy. Please take control of your financial life.